Okay, welcome back to Business 900 Week 5, Lecture 2. The last lecture meant to be just kind of a little bit of a tease. Sets the stage for us here where we're going to get into the issue of defining games. Right here, the authors, they give you a little bit of a provocation by going through the 10 tales of strategy and then offering to you, based upon those tales, a basic framework for thinking. And what I want to do is create a little bit of a bridge for us as they jump between chapters 1 and 2. We're setting the stage now for types of games, but let's flesh out some things a little more clearly. Here's a quote from Wayne Gretzky for some inspiration. He said in response to a query by a journalist, "What makes you such a great ice skater?" And he says, "I don't skate to where the puck is. I skate to where it is going to be." So let's go back. Just a brief review. We've seen that we're trying to describe strategic interactions. We assume persons are self-interested, and so is everyone else. We went through some very basic ideas, and now we're going to flesh them out. What we're going to do now is rules of the game have to be known, and figure out if we can manipulate those rules when they are flexible. And we'll also mention that much of what is hidden, in a sense, in the Thinking Strategically text would be a variety of game theory assumptions, and some of those are pretty good, some of them are a little bit weak. So the rules of the game basically revolve around the strategic environment. We saw that, players, strategies, and payoffs. We also have to take account of the timing of moves, the nature of conflict, and interaction. Timing refers to am I able to move, and then is another player in the game then able to move? So maybe there's a sequence. Could be that the moves are happening simultaneously. This is much more realistic to real-life competitive frameworks. We'll also consider the notions of conflict and interaction. How do we interact? What kind of results occur when there's a conflict? We'll remember to pay attention to informational conditions. That's very crucial for our strategic thinking. And we'll also cover the issue of agreements and contracts and whether those are enforceable. That plays out quite regularly in different market structures. Main assumptions we'll consider are those of rationality and common knowledge. Now, if you wanted to dig a little bit deeper, and many people do, they say, well, rationality is okay, but it only takes me so far. There's actually a movement in the field of economics and strategy dealing with the concept of modeling irrationality. Now, that movement is known as behavioral economics. And that is an attempt to draw in lessons from psychology to sort of normal economic analysis. But we have to lay down some foundations first before we head into those more complicated arenas. Remember that the strategic environment is player strategies and payoffs, right? Everyone in the game, we'll call it, in the strategic environment, has the ability to act in a way that would affect your earnings, your payoffs, right? The strategies are those actions available to the players of the game. They define, in essence, a plan of action for every contingency. The strategies are usually if-then statements, right? If we think one of my competitors is going to act in a certain way, then we know how to react. If we think a competitor is going to act in a different way, we know how to make an adjustment. So these are contingent plans, right? Payoffs refer to actual numbers that are shoved into these games just to help us do a little bit of analysis. You got to get some practice solving the games as the authors present them. So we'll put numbers into these matrices or decision trees so that we can do some analysis. And what those numbers need to do is be reflective of the actual interests of the players in the game. In terms of the timing of moves, what we'll do is boil it down to either simultaneous or sequential moves. In terms of the issue of conflict interaction, it could be that we are involved in a situation where our interests are in conflict. It could be that there are games that are more interested in when there's cooperative possibilities, but we'll look at conflicts. And we'll also look at whether the participants actually interact only once or repeatedly. As it turns out, what we'll find is that the game might result in a slightly different solution dependent on the nature of interaction. We'll look at the informational conditions. We'll assume for the most part persons have the same information, but we'll relax that and maybe some people are better informed. And we'll think about contracts. Can they be enforced? The teaser from last time was Toys R Us. Examining that case, we'll look at what was going on here in the context of game theory application. Sequential timing is what's happening. There was a threat that's being presented, and the manufacturers then make some decisions. We have to think of then, what would an opponent's reaction be based upon the action taken? We'll also consider that this is simultaneous timing if we're thinking about just the manufacturers instead of Toys R Us and manufacturers. The manufacturers interact with each other or they decide on their own. What they have to do is think about, well, what are my opponents in this context, the other manufacturers of toys? What are they doing right now while we are acting? And in terms of information, we saw in that game that the future profitability of the warehouse clubs was somewhat an unknown. And so what you have to do is you have to learn, if you do not have information, you have to use behaviors. You have to look at the actions of others to draw out an inference. Again, it's a little bit of guesswork, but you'll get better at it as you practice this. And then we'll look at the agreements. What would happen to someone if they broke an agreement? So you just got to have some kind of enforceability mechanism present in contracts. In terms of the rules of the game, we also must address this question. Are the rules of the game fixed? See, if the rules of the game are flexible, you should manipulate them to your advantage. I call that a commandment because this is crucial in business enterprise. The rules of the game are not fixed in business enterprise. Consider an example where one can alter the rules of the game. In this context, it's an agenda setting situation. This goes back to a presidential election, where a legal case arises due to the problem of vote count in Florida. This became a famous legal case that was brought to the U.S. Supreme Court. It was Gore versus Bush. If we were to examine the very basics of the court right then, we know that 4 judges would prefer Bush to Gore to a remand, the remand option being pushing it back down into the circuit court. 3 judges on the court prefer Gore to a remand and are not in favor of Bush at all. And 2 of the judges prefer a remand to Bush to Gore. Now they vote by majority rule, and there is a chair of the Supreme Court who actually has agenda-setting power. This means that the chair of the court can make a sequence of pairwise votes take place. There actually is no majority in a 3-way race. So the chair or chief justice selects some vote based upon the voting rule of majority opinion, selects a series of voting possibilities in a sequence. First vote put forward before the court is Bush versus Gore. If you did that, then we know that that you have this sort of clear winner that you can examine. You have to go back, maybe backtrack a little and look. Well, you know what? I'll do it. I'll backtrack just to remind you that Bush versus Gore is leading from 4 judges, and it's leading from 2 other judges. See, so Bush is preferred to Gore. When you don't have remand in the mix, then you see that 6 out of the 9 judges in the court would favor Bush. Or suppose you first put in Bush versus remand. And then what you'd have to do is say, well, then there'd be some kind of winner in that mix, and then line up that person versus Gore, right? Or you do Gore versus remand. So you figure out who would win Gore versus remand, and then the winner would be placed up against Bush. So now, once again, the member preferences. 4 of them prefer Bush to Gore to remand. 3 of them Gore to remand to Bush. 2 of them remand to Bush to Gore. Now, anytime there's a pairwise election, you can see the majority rule results. The second major bullet here indicates that Bush beats Gore, that Gore beats remand, and that remand beats Bush. So you might say that I see 3 possible sort of sets of rules that would play different games, generating different results. If you set up Bush versus Gore, then you would have a winner of remand. If you set up remand versus Bush, then your winner would be Gore. And if you set up Gore versus Remand, then the winner would be Bush. Let's assume that there's rationality among the players. They will all want to maximize their payoffs. That's all we mean by this. We're also going to say that the players are perfect calculators, that they take information in and make the best possible decision. It might not be true in life, but it is, shall we say, prescriptive, in the sense that these are general rules that would support outcomes that are, shall we say, optimal outcomes compared to a variety of other possibilities. So I mean prescriptive in the sense that now we have a framework that allows us to judge whether somebody has been rational. Did they actually seek to maximize their payoffs, and why not? And furthermore, if they're not perfect calculators, what kind of information situation did they have, and what kind of decision-making skills did they exhibit? You can see managers wanting to know these things because it helps us to put into place correctives. And of course, we'll assume there's common knowledge, which means every player knows the rules of the game. And not only this, but each player knows that each player knows the rules of the game. And furthermore, each player knows that each player knows that each player knows the rules. And that can go on forever and ever and ever. Hopefully you're getting the picture that this iteration is getting things kind of complicated. So what we need to do is generate kind of a simpler framework. Here then, if there is common knowledge, do people actually behave as the theory predicts? So that's the main question. Game theory puts into place a framework, indicates that under certain conditions, the particular result that we think should happen is a byproduct of our say, theoretical framework. Now, if people don't really act as the theory predicts, then we have something to go on. We have the ability to ask, why did that happen? Common knowledge comes up in a lot of different situations. Sometimes you have something known as intentional failure to coordinate. You have financial disclosure and grade disclosure meant to spread information to people or to hide information. Bluffing is a classic example of a loss of knowledge. And the stock market is really a efficient market because of the degree of information available to those who transact. And in the stock market, we suppose that rationality crucially depends on the fact that there's common knowledge. But you have to be able to predict how others will behave in order for you to take good positions in the stock market. Question for you just to think through, what would be this action that you would undertake? When would you sell off your stock if you knew the exact date that a bubble was going to burst? I'll leave that for you to think about. But of note, we know that he who panics first will win. The greater fool theory in finance works like this. You might be a fool to pay as much as you did, but what's going on here is that you're betting that there's a greater fool down the road. Someone later will buy this for you at an even higher price. And if you're right, then of course you're not foolish, that someone else is foolish. Now in the stock market, we know that there's not a very good month, shall I say. Blank often is a good month for stocks, right? Blank is typically a strong month. Blank tends to be a good month. Blank is usually a good month. Versus blank is typically a bad month, or usually a bad month, or traditionally a cruel month, or the worst month, right? You have to fill in that blank. You have to kind of think, how do people behave in these various months of the year? Now, if it's really the case that in each month the stock market is equally likely to go up or down, and it turns out there's about an 80% chance that some month is going to be bad 3 years in a row. Now, October, of note, is actually pretty bad. Why is it so bad? People have been wondering about October for decades and decades. Here's the October experience in 1987 with the Dow Jones, the New York Stock Exchange broader average, and the S&P 500. You see that what happened in October was not quite a market correction, but a fairly serious drop in stock prices. The worst month? Many people think it's October, a peculiarly dangerous month to speculate in stocks. It's just about as dangerous as July, February, December, April, November, January, June, December, March, August, and May. I mentioned December twice. I don't know why I did that. It's just weird. That's from the Wall Street Journal. pointing out that every month is dangerous. Examine the May 1988 front page article, "Clear Road Ahead for the Wall Street." Yeah, well, record gains will occur through the fall. October looms. This is the dreaded month, and we might have an inevitable slide. In May of 1988, you were about 5 months ahead. Then we trace 4 months, 3 months, 2 months, 1 month, and then we're in the midst of October. Stocks seem to be doing pretty well in 1988. We also know that in an IPO lockup expiration, an initial public offering, right, occurs. And what tends to happen is a bidding process on stock that alters the returns on that stock. And the lockup basically is a kind of phase where insiders are not allowed to act. They're not allowed to provide information. Everybody's working out the deal and setting the target date for the IPO. What we do know is that the process from about 20 days prior to the IPO to up to that IPO indicates a cumulative abnormal return that begins to fall quite shockingly. So that right before the event day of the IPO, you get about a -2 to -2.5% return. And then that plunges further down as you go. So that's just kind of pointing out our attempts to make predictions. A funny little cartoon indicating, right, stadium capacity data, some total pitches thrown data, strikes, peanuts sold, hecklers, blah, blah. What you have here is a number, 4,785, which is, as the professor points out, a ballpark figure. Oh, haha. So there's some, games played in financial markets, games played by the Fed. There's a general standing rule that says the prices of stocks tend to fall significantly after the Fed raises interest rates 3 times in a row. Now, if there's a booming economy, typically the Fed will fine-tune some key interest rates. That fine-tuning work up and down is normal. But if the Fed raises interest rates 3 times in a row, that tends to be an indicator of some effort, shall we say, of the Fed to try to keep interest rates pretty high for a foreseeable future. And interest rate risk is something investors face. So what investors will do is they'll sell off stock. They're trying to, of course, modify their portfolios in light of the higher interest rates. And this reduces profits, and the selling of the stock, of course, causes the stock prices to drop somewhat. This, of course, is modifying the interest rate risk premiums that are embedded in the stock returns. A brief summary of note: if you're not picking up on this kind of theme from Thinking Strategically, I'm hitting the main ideas that the authors present. It turns out that you're always in a game. It also turns out in the real life the rules are usually flexible, and you've got to learn how to think 1 step ahead and maybe even look 3 steps ahead. Looking ahead, what we'll deal with next is the notion of an equilibrium. That's how you solve a game for its strategy. It basically tells you what would be the best thing to do. And we'll look at the outcomes that arise from these games. So I'm going to stop once more, put this one up on Blackboard as the second lecture in the week, and we've got a couple more coming.